Very, very big welcome to all of you, and thank you for joining Samir and I this morning to run through our full year results for the year ended March 2024. It's been a better year for us. Certainly, the sentiment we're facing now compared to a year ago is a lot better. We did record our first quarter of net inflows, which is the last quarter of the financial year, first quarter of this calendar year, which was the first quarter of net inflows after 7 consecutive quarters of outflows. So you can see that was a big turnaround. That flow momentum has continued into the current quarter, which ends today. So pleasing to see a continuation of that flow momentum into this quarter. I'll talk a bit more detail about flows later on. Material net inflows into our emerging markets and Asian funds. Also net inflows into our artificial intelligence fund and increased interest in global tech, which won't surprise any. Assets under management up 14% to 21.9 billion at the 31st of March and up further to the 14th of June to 22.8 billion. That represents an 18% increase from the 1st of April at the beginning of our financial period. That left us with adjusted EPS 1% lower year on year at 44p. And given the improved flow momentum and improved fund performance, we were able to maintain the dividend at 46p. Just turning for a minute to market perspective, and I won't dwell on this too much. All of you would have lived and breathed this all the way through the year, but just to show the impact of some of the larger indices that we look at. And of course, everything driven by tech, very narrow, obviously, Magnificent Seven, the Fab Five, whatever you want to call them, really making it difficult for active managers in this environment. The S&P 500 was up 30% during this financial period that we're talking about now. And obviously, the Dow Jones Tech Index, which we benchmark our tech funds against, up even more than that. So an interesting period. And of course, really surprisingly, despite a rising US equity market, gold outperformed the US market in the last quarter. Very, very surprising indeed. Again, perspective, this is the Broadridge fund data. So this is pan-European flows across our sector by asset class. So you can see the only name in town going back the last 5 months has been bonds and fixed income. That's where all the money's been flowing. So that dark blue line is bond inflows. Equities is the light blue line. So you can see outflows from equities pretty much all the way through in this period we're showing here. So all the way through from April, a small month of net inflows in November into equities, and the bulk of that would have been passive as opposed to active. So a really, really challenging backdrop of industry flows across pan-Europe. Turning now to what really drives and differentiates Polar, and that is our fund performance. This chart, which we do show every 6 months, indicates our UCITS funds. So this represents 71% of our total AUM. And what it does is it reflects outperformance since inception, that's above the horizontal line, and underperformance since inception below the horizontal line. Dark blue is first quartile against the Lipper peer group. Light blue is second quartile, and the orange is third quartile. So you see we do have 2 funds in the third quartile, but the majority of the AUM across our range is in the top 2 quartiles, so above the median performance since inception. It's worth just dwelling a little bit on the smart energy, smart mobility, those 2 on the right-hand side of that chart, which don't look very good against the peers and against the benchmarks. The benchmarks on the fact sheets is the ACWI index. Clients don't measure them against ACWI. Clients measure them against what we call a reference benchmark. So because this is all about clean energy transition, they only have about 250 stocks in their investable universe, and that's what they measure their performance against. So essentially, everything else in the ACWI universe is screened out, and they effectively select a portfolio of 50 stocks from a total universe of 250. And that's what they aim to beat on a long-term basis. And currently, they are beating that. From a compliance point of view, we could not show the reference benchmark because it's an internally generated benchmark, not an external one. But it does just require some explanation on that. In terms of our performance improvement, so this is to the end of May 24. Again, this is the quartile ranking. And you can see May 24 versus May 23, 94% of our AUM over 1 year is in the top two quartiles, compared to 79% a year ago. Over 3 years, 91%. Over 5 years, 86%. And since inception, 99% of our AUM ahead of median, so in the top two quartiles. So that's a fairly material improvement in peer group ranking year on year, measured to the end of May. Just looking at performance relative to benchmark, because obviously our investors look at us both versus peer group and versus benchmark. And you can see there again an improvement. So current year to date, over 50% of our funds ahead of benchmark. And certainly since inception, over 80% of our AUM ahead of benchmark. Capacity is a key strength of Polar Capital, so it's one of our differentiating factors. We do manage capacity very, very carefully. The firm belief is that too much volume destroys performance, the law of diminishing returns. So we capacity constrain our funds and just make sure they don't get too large. What this chart does is it shows you what the total capacity for each of our strategies is, and the dark blue shows you what the current AUM is. So it gives you some idea as to what the remaining capacity across our current 13 teams is. Total capacity at the moment, given current market liquidity and market levels, is £63 billion. We're managing 22 billion, so our remaining capacity is 41 billion, so quite significant. What is important, though, is to work out where that capacity is. And that capacity is in funds that are currently receiving inflows. So emerging markets in Asia has 3.3 billion of remaining capacity. European income, 3.7 of remaining capacity. Sustainable thematics, so that's smart energy, 9 billion odd. An artificial intelligence fund launched 6 years ago that has 3.4 billion of remaining capacity. Flows, turning to flows for a minute, that's our AUM profile going back to March 2019. So you can see the light blue line is showing you the average AUM trading 12 months. The orange straight line is showing you the compound annual growth rate of AUM over that period, about 9.6%. That, of course, includes the big drawdown in March 2020, where AUM declined by 2 odd billion, obviously rapid incline, both market and flows, all the way through September 20, March 21, peaking in September 21 at 23.4 billion. What's quite interesting, we then had the sell-off in that last quarter of 21, so spiking inflation, interest rates ratcheting up quite rapidly, markets obviously coming off and selling off quite rapidly. So we had both market declines and outflows over that period of time. And we've just emerged from a 2-year period of net outflows, not dissimilar to our peers. But encouragingly, that is now changing. And at 22.8 billion on the 14th of June, almost back to our high watermark in September 2021. Very encouraging. Net flows over the 12 months in the reporting period. So that's from April last year through to March this year. You can see net inflow in April last year, so encouraging then, but I'll be back into net outflow. The most brutal month for us was December last year, and that really was focused on 2 or 3 very large clients, one of which decided to go passive, and then a much better picture in January and February, and of course a very strong March for inflows, which meant our first quarter was a positive quarter. And that momentum has continued, and I'll show you that on the next slide. That just shows you gross and net to give you some idea as to where the inflows are coming into. So on the left of that left-hand chart, emerging markets in Asia, that was the dominant net inflow, so 400 million pounds of net inflow over the financial period. European income, sustainable thematic equity, that's smart energy, had inflows, and of course, to the right, the biggest outflow was our European Opportunities Fund. So that had a really, really tough time. Reduced sentiment for European equities, Ukraine, small mid-cap bias in the fund. So really just a flight away from European equities over the period, and we felt that. Healthcare on the right-hand side, that was an anomaly. That was a very, very large, long-standing client that redeemed out of our biotech fund. So slightly sort of one-off in there. And the chart on the right-hand side, what that's showing you is gross inflows above the line, dark blue, gross outflows, light blue below the line. And that's just to give you an idea that all these strategies actually had gross inflows during the year. And what caused the net flow was obviously the gross outflows were larger than the gross inflows. But it's encouraging that actually investors were investing across the board throughout the period. I think more importantly, and just to bring you more up to date in terms of the flow profile, those are the flows into the strategies for this calendar year to the 14th of June. So again, you can see emerging markets in Asia very, very strong in this calendar year to the 14th of June. Global tech, you can see, has come back in a big way. Global insurance has come back. Healthcare has come back. And you can see European opportunities much lower, net outflows. Convertibles is difficult. Typically, our investors would invest in our convertible funds to get yield at a very low and on very low volatility. Clearly, when you're competing with cash and cash funds yielding 4.5%, 5% with no risk at all, there's no point in going into a convertible fund. So we've seen clients coming out of that and going back into fixed income. And of course, sustainable funds have not been in demand over the last 6 to 12 months. So we've seen some very, very small outflows from our smart energy fund, again, in line with our peers. Samir, I'm going to hand over to you for this one.
Thank you, Gavin. Good morning, everyone. So as I take you through the numbers, I will just, in terms of context, obviously just flag to everyone, very clear and very obviously, as we look at the numbers for the financial year ended March 24, we're looking back 12 months across to that second consecutive year of headwinds for the asset management industry in general. And hopefully, as I take you through the numbers, what we'd like to think is that the picture that numbers show is one of a business that is in a healthy position and has weathered that consecutive 2-year period and come out in good shape. So the picture the numbers present is this. When you look at the first driver of the business, really average AUM, year on year, that number is flat at 19.6 billion. But if you recall, at the interim stage, we flagged that at that stage, at September 23, average AUM was running roughly 3% behind the prior period. So for a good period of time, average AUM has been lower. And over the second half of our financial year, as markets have improved and performance has improved and buoyed that average AUM number, we've clawed some of that back. Why is that important? Because average AUM obviously feeds into net management fee revenues, which are down roughly 1% at 154 odd million for the current financial year. Net management fee yield, or the revenue margin on net management fees, 78 basis points is 1 basis point lower. And that is well within the range of 1 to 2 basis points of fee erosion that we guide the market towards. That is a function of structurally, that is the trend, unfortunately, for fees in the active management space going forwards. But also for the business specifically, there is a bit of change in product mix happening that we manage very, very carefully as we look to do more business and we launch new funds and seed those funds and collect money at slightly lower rates, plus also picking up more share on segregated mandates. And we manage that change in product mix very, very carefully to the tune of managing that fee yield to 1 to 2 basis points lower year on year. Looking at profitability for the business, there are 3 main lines of profitability. The first important line is core operating profit. And that is really net management fee revenues minus all costs, operating costs of running the business, all excluding performance fees for a second. And that core operating profit number was roughly 45 million for the financial year, 6% lower, partly a function of lower average AUM, lower management fees. slightly higher operating costs, which I'll speak to over the next couple of slides. Pulling all that together, roughly 6% lower and within the market context, that isn't too bad an outcome. Looking at core operating margin, that is 29%, and that has stayed consistent with where we were at September 23 at the interim stage. So still a very healthy position in terms of the business overall. The second important driver of the business is performance and how well we do against benchmarks. And that feeds into performance fee profits, the second line of our profitability. And that is essentially performance fees minus performance fee related costs, which are essentially staff costs, because we do operate a very profit share, revenue share model. So that how well we do against the benchmarks feeds through into that second line. The third line is other income. And remember, that is the P&L on our seed portfolio, net of hedging costs and bank interest income feeding through to that line. So pulling those three lines of profitability together, the overall picture was adjusted diluted total EPS, as Gavin flagged earlier, 44p versus 44.3p last year, so slightly lower. And really that position matched up with the improving investor sentiment that we pick up on, the improving net flow profile that we see, and our confidence in our ability to grow the earnings of the business going forwards really has enabled the board to declare a second interim dividend of 32p, which maintains the full dividend at 46p. Looking at costs in slightly more detail, we are a people business, and staff compensation costs are a big component and the biggest component of overall operating costs. Looking at that chart on the right, everything to the left of that reddish bar chart is essentially a function of variable staff compensation costs coming down slightly, driven by the fact that as profits have come down, shares to the teams and to the staff in general come down. And looking at that red bar, that is staff compensation related to performance fees. Performance fees are higher this year, so that share is higher. Pulling that staff compensation component together, overall staff compensation costs were roughly 3% higher year on year. So again, fairly well managed in the broader context of what's happening with inflation and overall cost creep. The two bars on the left, on the right of that chart, then other operating costs slightly higher, but compensated by exceptional costs. We'll look at those two in a bit more detail on the next slide. But when you put all of that together, total cost, operating costs for the business have moved from 119 million to 120 million year on year, which is roughly a 1% increase. So very carefully managing those overall cost base. Why are other operating costs higher year on year? Just a reminder there that they are higher for the reasons, exactly the same reasons that we flagged at the interim stage, at the same run rate. And at that stage, we said overall costs were running higher because we had taken on more space within our current place of business here at Palace Street in London, and also extended the lease out another few years to 2028 to give us good medium-term clarity on occupancy and room to grow for the business, because we are a growing business. The other areas we signaled at the interim stage where we would do more was more traveling, more client engagement, more digital marketing content, to really get out there, engage with our clients, and really view that as an investment for when investor sentiment started improving. And really that investment has started bearing fruit, as Gavin's mentioned, in terms of the flow profile. Exceptional costs are non-recurring or non-cash, and really the only exceptional costs are the amortization of intangibles related to the investment management contracts picked up under the Dalton acquisition a few years ago. And the overall costs are lower as the termination costs related to Vaishyan go further into the rearview mirror. So lower costs and overall, as I mentioned earlier, overall costs only 1% higher year on year. That over the next few slides, we look at the balance sheet. And when we talk about balance sheet strength, one reference is to the cash and seed investments on our balance sheet, roughly 140 odd million at the end of March. Taking a look at their seed portfolio, the only real change is recycling the seed money in our Smart Energy Fund pretty much at the start of the financial year, as that fund went through 100 million sterling at that point, and we took that seed money out, which is roughly the level where we look to recycle seed money. That fund is now roughly 200 odd million, so moving along nicely. No other changes. Overall, 7 funds supported by our seed portfolio year on year. Another look at what that balance sheet strength means: surplus capital over our regulatory requirements and that second interim dividend provision. That surplus standing at 50 odd million at the end of March. The bar chart on the left really shows the allocation of capital on the balance sheet. Message really there is no real changes. The framework and how we think about using capital stays consistent. We will look to seed new product ideas because that is really the R&D side of the business. We will continue to have a share buyback program that quietly works in the background to dilute the impact of share incentives. We will look to try and retain that balance sheet strength for exactly difficult times such as these last few years, and we'll look to return value to shareholders through ordinary dividends. And talking about dividends, just a reminder, total adjusted EPS, as I mentioned, 44p, which has enabled us to maintain that annual dividend at 46p. And just in terms of context, every 1p of dividend that we declare and pay out is roughly £1 million in cash outlay for the business. We are uncovered by roughly 2p. That's £2 million that we've used that balance sheet strength to support that dividend by. So that gives you some sort of context in terms of what we are doing and how manageable that is for this particular year. Otherwise, the dividend policy remains unchanged. Under normal circumstances, we'll pay a dividend out within a range of 55 to 85% of adjusted earnings, depending on what the outlook is. And really, that maintained dividend this year is a function of the improving outlook, balance sheet strength, and our confidence in the business. And talking about that outlook, I will pass back on to Gavin to take us through strategy and outlook looking forward.
Thank you, Samir. Just to show you what the tech concentration is, tech was 56% of our total AUM in 2020, so that was at the end of that very rapid inflow and all the COVID winners. It's now 45%, so a much more balanced picture. The 45% for us is the correct number. If you look at tech and tech-related sectors in the global index, it's probably not far off that. So we're quite comfortable with that. What's encouraging is obviously the growth of our emerging market strategy in Asia. That's grown very, very well. So has global insurance. That continues to grow. So a much more diversified picture in 2024 than there was back in 2020. Just to spend a bit of time on what's really driven flows into emerging markets. So this is a team, just to remind you all, that joined us. It was a lift out back in 2018, launched in the summer of 18. They've now gone through 2 billion of AUM. Very, very strong performance against a backdrop of net outflows in the emerging market sector globally. So we've taken market share. And the reason for that is a very differentiated and sustainability-focused process. And you can see on the left bottom that those figures there is the performance since inception and over 1 year of the Emerging Market Stars Fund. So you can see 21.1% outperformance over 5 years versus benchmark, and over 1 year also very, very strong. The Asia Fund, that's Asia ex Japan, so that's developing Asia. Likewise, very, very strong performance, cumulative over 5 years, and of course 1 year and 3 year performance. So again, the key there is taking market share. The sentiment for emerging markets will change more positively when the dollar weakens, if the dollar weakens in the near term. That is good for emerging markets, as many of you know. It's a large team at Polar, with a research presence in Mumbai, India, also with research presence in Shanghai. So feet on the ground, quite important when investing in the emerging markets. The Emerging Market Stars Fund is in the 10th percentile since inception. So again, against peers, very, very strong. The other area where we've seen a lot of interest, and that's technology, for obvious reasons, and also the AI fund, where our team, probably the largest tech team in Europe at the moment, a lot of experience. Their view is AI is a structural and secular trend. This is here to stay. It's going to bring efficiency. It's going to bring disruption, and our team is well placed to identify that. And that's what the AI fund really seeks to do. It is a global equity fund looking for AI enablers and AI disruptors, so we can try and benefit our unit holders from that. The AI fund specifically, so again, launched 6 years ago, October 2017. You can see the outperformance against its benchmark on that chart. This fund is second percentile against its peers over 5 years and third percentile since inception. So very, very strong fund, growing rapidly, current AUM 635 million, and a strong pipeline. As you can see, high active share for obvious reasons. That's the profile of product closures and launches since 2017. So you can see we don't only launch new funds, we also close funds down. So you can see all the way back 2017, we closed a global alpha fund, an emerging market growth fund, an international alpha fund. They were just not getting traction. Performance wasn't compelling enough to really provide a long-term future for that. 2018, we launched the emerging market suites. That's done very, very well. 2019, we closed the European income fund down. That's the pan-European one. In 2020, we launched a mutual fund for the emerging market strategy in the US. We also launched Healthcare Discovery. It's a small cap emerging healthcare fund. 2021 saw the Melchior European Opportunities Funds coming from Dalton. We also then closed down our Asian Opportunities Fund and our Emerging Markets Income Fund. Again, against a very, very difficult backdrop of investing in emerging markets with a value style bias. Moving on, you can see 2024 now, we have launched a European small cap fund. We've also launched an emerging market healthcare fund. And in September, we are launching an international small company fund that will be managed by Dan Boston out of Florida, focused purely on US client base, investing in international, so that's ex-US, smaller companies around the world. He brings 20 years of experience. He managed $3.5 billion at his previous employer, and we're very excited with the arrival of Dan later this year. So that's the future pipeline for Polar. We've also done quite a bit of work on diversifying our distribution footprint. So you can see there, the Nordics has been a key area of growth for us. So that's been supporting the Emerging Markets Fund. That team had a very, very good profile in the Nordic region. So that's grown very, very well, to the point we now have an office in Stockholm to service those clients in the region. Singapore, also with a local office, that's to service our growing Asian client base. And of course, the US, we've built capability there in anticipation of selling emerging markets in the US and also selling the International Small Companies Fund in the US. So fairly well represented across the globe at the moment, and far better positioned than we were, say, 5-6 years ago, where we were very much more UK-centric. Awards, I won't go through the detail of those, but again, it's nice to have third-party recognition for some of our funds, the most recent being the Polar Capital Global Insurance Fund, which won the Specialist Equities category in the Investment Week Fund Manager of the Year just a few weeks ago. So, as I said, nice to have third-party recognition. So down to the outlook, and just to summarize, and then we can get into some Q&A. We tend to extend teams to create more capacity. So AI would be an example of that. 6 years ago with the technology team. That's when AI was born. The International Small Company Mutual Fund launch later this year provides a differentiated product for the US market. The current AUM, as Samir mentioned, the current AUM is at a much higher level than the average AUM for the last financial year. So that bodes well for the outlook going forward. The improved fund performance, we know that fund performance precedes flows. So if you have good performance, you're far better placed to receive inflows into your funds than if you have bad performance. And so, our improved performance again bodes well. Our continuing strong balance sheet gives us confidence, and that enabled us to hold and maintain the dividend. And of course, as I said earlier, we have significant remaining capacity to continue providing returns for our shareholders. Thank you very much. And if I could invite any questions, I think, Andy, through you.
Lots of questions. Let's roll in. Firstly, I might link two together in terms of your growth ambitions and the capacity that you referred to. Maybe for you, Gavin, with an ambition to get to 30 billion sterling over coming years, which particular polar funds do you think will be the biggest contributors to that growth?
I mean, a lot depends on market sentiment. There is capacity in a number of our funds. I mean, it won't come from one or two. It'll come from a number. I would say at the moment, and this can tend to change over time, the biggest pipeline is emerging markets. I would say technology still continues. Healthcare, we're seeing a lot of interest. So I would say across those three broad strategies, global insurance also very, very strong. Although global insurance probably has about 1 billion of capacity left. So certainly a strong contributor. And I think importantly, what we're also seeing is definitely a changed sentiment towards UK equities. So we do see some potential for our UK Value Opportunities Fund, which has got very, very good performance, and we are seeing renewed interest there. So I think we've probably got 5 or 6 strategies that will contribute towards that continued growth. And just to be clear, that 30 billion ambition is an aspiration, and it's over the next 3 to 5 years. So it's effectively saying we are fairly confident we can get there over the next 3 to 5 years, given the current structure of the business and its performance.
Great, thank you, very clear. And Samir, and the other side of the coin for you, appropriately, fixed costs have been very tightly controlled. How much do you think that human and technological infrastructure has the capacity as it stands at the moment to cope with that additional AUM, or indeed more as it comes along, or will there be gradual cost increases as capacity grows?
That's a very good question, because as active asset managers, the only way we're going to compete is if we are very, very careful in the cost base that we take on to be able to manage AUM, which is just the classic operational leverage. And we think we have a very good model. We are very, very specialist and thematic in terms of the strategies that we offer. So therefore, we charge a premium. That takes care of that top line, the revenue. But equally, we need to be very sensible in how we manage the cost base. And the way we do that is, look, we take a long-term view. Our view of growth is preferred route is, as Gavin's mentioned, either team lift outs or product extensions with existing teams. Now, they are lower risk, but you need to be patient because they do take time. But they do also take a cost investment. So the way we manage that is we sensibly stage and manage that cost investment over time, and don't allow the business to get into a shape where we either have to rapidly invest in IT infrastructure or take on costs to catch up with growth. And we try and invest and prudently manage the business over the long time. So if I pull all of that statement together, what we're really saying is, if the growth engines start to fire, sentiment improves, we should be able to manage reasonably more AUM for not more significant creep in the cost base. You should start seeing operational leverage come back, and that profit margin starting to expand There will obviously be cost creep, but we will manage that very, very carefully.
So I think that operational leverage is something that would be an attraction to see, I'm sure. Thank you. A specific technology question, presumably related to the success you've seen in AI already. Do you have any strategy regarding Bitcoin, crypto, or blockchain, and any existing direct or indirect investments in that space?
Andrew, that's a very short answer to that, and the answer is no.
All right. A very short and accurate answer, I'm sure. Thank you. Lots of good performance. Question here, is the outperformance since inception of the UCITS funds affected by fund closures, i.e. on a survivorship bias?
Yes, the answer is that long-term chart I spoke through earlier on, it definitely looks better because of survivorship bias. So that's something I will admit. We do tend to focus on housekeeping all the time. So we will weed out the underperformers. That's absolutely critical. I mean, you know, my view is there's no point in supporting funds that are never going to grow, that are going to remain subscale, because all that does is it utilizes operational capacity and you know, capacity from the sales team. So the answer is yes, there is survivorship bias. So yeah, we will see very, very good long-term performance.
Okay, returning to technology, more of a tapping into your experience here. A question: Do you see any bubbles in sentiment forming within Polar Capital Technology Investment Trust, or indeed a more broader overheating of the technology sector at the moment?
I mean, that's probably above my pay grade. You need to ask the tech managers. So Ben, Nick, and Zushan would have a fair view of that, and I think they would say no. I think where we are now with tech, and a lot's been written about this in the media, where we are now with tech is very, very different to where we were in the late 90s, where it very much was a bubble. I mean, tech now is being driven by proper cash flow earnings. It's not about burn rate. It's not about massive valuations on revenues. No focus on profit. But yeah, I mean, the market's very narrow. It's very, very difficult for active managers when you've got Nvidia growing at the rate it's grown. It's knocking on 10% of our portfolio, and that's because Nvidia as a percentage of the index is up there. So you know, is Nvidia a bubble? Well, you know, that is genuinely growing. It's producing profitability. It's got a very high profit margin, and it's leading the whole AI revolution. AI itself is secular. It's here to stay. That is not a bubble. But of course, you will get companies within that will do very, very well in the short term and not so well in the longer term. So that's up to our team to determine who are the winners and who the losers on that. But when you do get such a narrow market, it does become difficult for an active manager, because unless you have those in your portfolio, you can significantly underperform if those continue running.
Yeah, very true. Samir, one perhaps for you, question: could you confirm the sharing arrangements associated with performance fees in FY23 was 75% paid to the fund managers, and in FY24 that looks to be around 50%. Is that a correct assumption?
No, the profit sharing arrangement doesn't change. It's fairly consistent year on year. What will tend to happen is last year fees were lower, but when you look at the statutory lines without any adjustments, because of the impact of deferment, deferment means that any payouts to the fund management teams need to be staggered over a 3-year period. So you get anomalies. If you've had high performance fees in a prior year, those costs are pushed into potentially years where there are lower fees, and that cost ratio that people might be tracking on statutory lines becomes misleading, funnily enough, which is why on a statutory basis, on an adjusted basis, what we do is we say, look, let's remove the deferment impact for a second. It's important. It's there for a regulatory reason. We understand that. But if you've earned something in a year and you have a share in that year, that's the position the adjusted line tries to show. So That's why on the adjusted EPS, everything that has been earned in the year is matched off against the revenue in that year. So in simple terms, to answer the question, the arrangement hasn't changed. It's roughly what you're picking up in FY23. It's roughly between 40-50% on profitability. That hasn't changed.
Okay, and following on from that, in terms of the challenges of attracting and retaining talent in the asset management industry, do you think there will be a tilt in the distribution of the performance fee further towards staff in coming years, or will the percentage of the gross performance fee remain pretty stable?
Well, I'll try and answer that question in a couple of ways. One is, I think we have a very clearly articulated mechanism around compensation. It's one of the three things that makes Polar an attractive home for fund managers. As Gavin alluded to earlier in the slide deck, we manage capacity to enhance and maintain performance. We give our investment teams investment autonomy. So they have complete investment autonomy within the bounds of risk oversight and investment oversight by our central teams, but also fair and transparent compensation. So each of our teams is effectively on pretty much the same sharing structure. Everyone knows it, everyone sees it. So that's really powerful and attractive. Leading into the question directly, we think that model has sustained the test of time. We are still attracting teams on relatively the same model. We flipped it slightly into a revenue share rather than a profit share model, but the net payout ratio is the same when you look at it. It's roughly 28 to 30% of revenue. That is still rich enough to be able to attract attractive teams. What is though happening is within the European and UK space, we are finding, funny enough, because of deferment, it is becoming more complicated and more expensive to attract and lift out teams, but it is still very, very possible. Do we see us needing to enhance or change the ratio? We don't think so, because the overall offering, yes, the compensation is important, but the other factors that we are able to offer are equally as important to provide fund managers a stable and happy home in which they can focus on what they're good at.
Yeah, and then a last question on staffing, a nice factual one. Approximately, what is the number of fund management staff that you employ, and how is that relative to the number of non-fund management staff that you employ?
So I think off the top of my head, we have overall 200 odd staff, and the fund management teams will be roughly about 60, I think, of that staff. And then you will have distribution, probably another 40 odd in terms of headcount. And then you'll have the various central teams combined.
Okay, very clear, thank you. Coming back to AI, Gavin, perhaps one for you. A question is, given your answer to the earlier inquiry about the long-term importance of AA, how is Polar actually incorporating AI into its own internal work streams and analysis?
So one thing we're not doing, if I can start off by saying what we're not doing, we're not spending billions on building large language models. That's not what we do. What we're doing is we're leveraging off what other people are doing in this space. So we've got a number of initiatives within Polar using AI and data, and I think the most advanced one is the tech team itself, the healthcare. But many of our teams are using AI to effectively distill and understand research. So it's, instead of analysts spending hours and hours and hours pouring through sell-side research, pouring through documents, we've effectively got a tool now that goes through everything, looking for keywords and pulling stuff out and effectively presenting a summary of literally thousands and thousands and thousands of up-to-date research from around the world on a particular company, for example. So that is something we are probably most advanced on. Clearly, the writing of fact sheets, commentaries on fact sheets. That's an area we're experimenting with now as well, in terms of getting AI to actually participate in writing the first draft, and the fund manager then has something to edit as opposed to starting from scratch every single month. That's an area we're looking at as well. So there are a number of areas, but we will leverage off, for example, Microsoft Copilot. We will use tools like that to make Polar more effective. So, I mean, to Samir's earlier point, we expect over a period of time that our headcount won't actually increase that much, because we'll become more efficient in terms of how we actually support the operations of the business by using automation and AI.
Right, very sensible. Couple of questions on the International Small Cap Fund. Firstly, what are your ambitions to where can you grow AUM to over, say, the next 5 years? And could you elaborate what market cap range you will be looking at within the fund for those investments?
Yeah, so I mean, difficult to give a number in terms of where we expect AUM to come from and go. I mean, we always say it takes at least 3 years to start getting traction, because typically your investors will wait for a 3-year track record number. So we will seed the fund initially. It'll then get its track record going. And you tend, like we've seen with emerging markets, I mean, that's in its 6th year now, you will then tend to get a hockey stick if all the factors are positive. In other words, if the performance is good, if there's demand, if the asset class is in demand, and so on. So I think a lot depends on where investors are going to see future value. Is it going to be in large cap, as it has been for some time now, or is it going to be in small mid cap? So I think, the sentiment is a big driver for us. So we don't go out and put hard and fast, we want this fund to be at X, Y, and Z over the next couple of years. It's got capacity in excess of $5 billion. That's what I can say. The manager was managing $3.5 billion quite comfortably. That had grown fairly quickly at his last employer. So that does give us confidence as well. But we're building a new team around him. So this is not a ready built team like we had with emerging markets or with smart energy. Those were full teams that we got. Here we've attracted a very, very good manager who now wants to build a team around him to meet him. So I think we've been cautious on that. I think the question in terms of market cap, probably 5 billion, but he will let his winners run. He will let his. I mean, he will not sell a holding in his portfolio because its market cap goes through his upper limit. He will let the winners run. I think that's an important principle. When he puts a position in his portfolio, it will typically be below a certain market cap limit. And of course, small mid cap from a US perspective and globally is very, very different to what you consider to be a small cap UK company.
Yeah, definitely different numbers of noughts. Couple of questions on the diversity of your fund's offering. You've been winning market share, and your fund's been performing very well. Is it simply a question of investment performance and winning new mandates, or does having a broad range of funds play an important part as well?
Well, I think diversification is important, and I think, as any investor would know, you can actually over-diversify. You can dampen performance by over-diversifying. So we are focusing as well. We do currently have 13 autonomous teams. They all do different things, but they will perform at different times of the cycle. So we're very comfortable with that. So yeah, we will always have some that are underperforming. We'll always have, hopefully, most that are outperforming. But we're reasonably comfortable with that sort of broad range. I would say that we are fairly US equity heavy at the moment. So all those global thematic funds, technology, healthcare, insurance, global financials, typically a very, very large component of those underlying portfolios is US equities. And that's why we're looking to really try and grow emerging markets and international, to try and get more non-US equity exposure across the board. The thesis being is that the US market has had a really, really good run for the last 2 to 3 decades. And the valuation dispersion between the US and other both developed and undeveloped markets is at an all-time high. And at some point, that valuation gap will narrow. And we want to be in a position where we can capitalize on those particular flows, where possibly investors will be saying, well, actually, the US has been very, very good for a long time, but now it's maybe time to start looking at other developed markets like Europe, like the UK, like Japan again, which is becoming a lot more investable. Japan's an interesting one. We've got a very small fund there, but we're seeing a lot of interest in that. So I'm reasonably comfortable. Yes, we are long only equity. We have one long short fund. We have another alternative fund, which is convertibles. That's having a tough time at the moment. But we make a virtue out of the fact that we are bottom up, focused, active managers. That's what we do, and the universe is big enough for us to continue performing. We're starting with a relatively small base.
And bigger picture, there has been, indeed, it's ongoing, a lot of consolidation in the asset management and the wealth management segment. Is Polar happy to bolster its organic growth by adding key people and teams, as you have done successfully, or might the absorption of a competitor accelerate the path to your scale ambitions?
I mean, Andy, I always say we aim to be the best, not the biggest. So size isn't driving our ambitions at all. We want to be recognized as being very, very good at what we do. So we're not on a race to bulk up. We don't, not that we don't like it, but we much prefer organic growth, where we're extending existing teams, we're giving up-and-coming analysts within the teams a chance to run a new fund and so on. So, I mean, the AI fund is a prime example of that within the tech team. So the best return at the lowest risk for our shareholders we can do is effectively extend existing teams. Team lift-outs is what we call organic growth. So that's effectively hiring really, really good managers anywhere in the world, bringing them in, and then build them up from scratch. Because that way you don't dilute culture. I mean, Polar's got a very, very strong culture. It's a performance-led culture. It's very, very transparent. It's meritocratic. We want to keep that. And it's, as soon as you start doing very large mergers or very large acquisitions, you start grappling with culture dilution, is what I call it. So that's not an area we actively look for. We get shown many opportunities, but it has to be something really, really outstanding. There's got to be compelling reasons why we would take it seriously. So ours is not an acquisition strategy. Ours is a growth with diversification strategy. That's what the strategy is. And we are fairly patient. And as you can see now, we've been doing this now for 7 years since I've arrived, and it's paying dividends now because we've been patient.
Yeah. Stick with what you know best, and always good advice. Just a couple more questions. On your share listing, we have a question. Are you comfortable with AIM? Have you taken any advice on business relief, which is obviously a slightly political question potentially at the moment, or given your propensity to or exposure to the US, have you had thoughts about listing over there?
Yeah, I mean, market cap at the moment is about 560 million sterling, so we're at the small end. We're not the most liquid. I think if I could have one wish, is that we get more liquidity. That's improved more recently. The board does examine annually whether AIM is the appropriate market or whether we should be considering the premium market. And the view is that AIM is absolutely fine. We achieve what we want to achieve on AIM. We tend to exceed the disclosure requirements required of an AIM company. So we tend to present more in our annual report, more in our presentation. So we're comfortable with disclosure. So that's not the reason not to go on the premium market. But at the moment, we don't see much benefit. I think the politically focused question in terms of, will AIM companies still be IHT exempt going forward? That is a big question. So, I mean, I would have thought we've got quite a few shareholders who hold us because it's inheritance tax free at the moment on AIM, and that is a worry. I mean, no one quite knows where that's all going to sort of pan out. But I think if IHT goes on AIM, it'll have a detrimental effect on the AIM market. Not all those companies will move to the premium market. Some of them won't be able to. So I think it'll be I think a further nail in the coffin for UK quoted companies if that is the route it goes. But for Polar at the moment, we're quite happy on AIM. We don't think moving to the premium market will give us any more liquidity or any valuation advantages.
Yeah, thank you for your transparency. And then drawing again on your experience, gentlemen, final question. You mentioned the turbulent markets of recent years, and there has been quite a strong flow towards passive equity investment strategies or ETFs. Do you regard that as just a cyclical shift, and is active investment still, I think I know your answer to this, the place to be?
Passive is secular, it's not cyclical. I think as investors focus more on the cost of their returns, that's what's driving passive. I think there's a place for passive investing. Obviously, you get exposure to the larger companies where active managers have less advantage. So the way we play that is there's still a massive amount of demand for active equities. And from a polar point of view, we will look at strategies that are less easily replicable by passive. So we differentiate ourselves in saying we are active managers, and we will manage funds that you cannot get through an ETF, or you might find an ETF, but it won't be as representative as what we will do. Hence, international small companies. We can add alpha there. We can't add alpha by having a look at a sort of a large cap component, because you can buy an ETF to replicate that. So we try to be different. We try to differentiate, and we make sure that we've got fairly high active shares in our portfolio processes, so we can produce alpha over the longer term for our clients. I mean, there is a time where passive investing can be quite dangerous, particularly like now when you've got very, very high concentration in very, very narrow markets, because your market cap weighted indices are effectively just pushing more and more money into those very large $3 trillion market cap businesses.
Yeah, very true. And history has warned us about that. So. Right, I think we're done. Our thanks to the audience for a very extensive range of questions, and of course to Gavin and Samir for an excellent presentation. Congratulations on your performance, and we wish you all the best for continuing this momentum. A last request to the viewers: you will get a feedback form, and of course the company would be very pleased to hear your thoughts about this presentation and the business. So thank you again, gentlemen.
Thank you, and thank you everyone for your support.
Thank you all very, very much.